Retirement income is a riddle with a different answer every time. One retiree's perfect drawdown plan could be another's tax disaster. But what can help you find your way is learning from the successes and stumbles of others. So, we've invited one of Canada's top financial columnists to share his secrets to a wealthier retirement gleaned from over 30 years in the business. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise, and I'm excited to crack the retirement riddle with you all today. I've got many years to go until my golden years, but you better believe I'm taking notes here. And I think investors of any age can really benefit from what we're about to hear. Of course, it's never too early to start planning. So on that note, let's bring in financial columnist, blogger, and author Jonathan Chevreau. He writes the Retired Money column for Money Sense, and he's written several books on investing and retirement. Plus, he runs the website Findependence Hub, a resource for those pursuing financial independence. John, it's great to have you with us. A long list of accomplishments with many more to come, I'm sure. Appreciate you making time for us.
My pleasure, Rob. I'm looking forward to it.
I think it's pretty safe to say here that you've probably forgotten more about investing in retirement than I'm ever going to know. And we're going to get into some of your tips for stretching the dollars and cents of a nest egg, of course. But before we get into that, I'm curious, what would you say is the secret to a satisfying retirement from a psychological standpoint?
Well, as we see in the book Victory Lap Retirement, which I co-wrote with Michael Track, you need a reason to get up in the morning. Just because you're retired doesn't mean you only have 16 hours a day now instead of 24. There's still 24 to fill. So clearly you need purpose. And historically, it's all based on family, relationships, hobbies, communities like church, for example. My wife's quite involved in that. So you need a reason to get out of the bed in the morning, essentially.
It's that old adage, you have to retire to something, not from something, right? So I'm curious, in your life, you're semi-retired yourself, how are you finding purpose on a day-to-day basis?
Well, I find it pretty busy. I'm busier than I want to be. I just came back from 2 weeks in France, as you know, and I had to keep the Financial Independence Hub going. It's been going for 10 years, and for the longest time, it was one a day. 52 weeks a year. It's quite a lot, and it means mostly other people are writing them. Several of your guests have been on there, for example, Michael Wiener. But in retirement and semi-retirement, I sort of throttled it back down to 4, and when I'm on vacation, 3 a week, like Monday, Wednesday, Friday. So that alone is like a full-time job. It's a 3-hour day on a good day. And then the topic of what we're talking about, keeping track of the markets, is also quite busy. I guess, like many people in the retirement club, Dale Roberts, I believe you've had him on as well. These people kind of live and breathe this stuff. I think it's part of their. Perhaps it's a danger. We can go into that whether investing should be a hobby or should it not. But maybe that's a different topic.
Yeah, it sounds like you're certainly keeping very busy here, and I know your readers appreciate you're so diligent with your posts on Findependence Hub, so appreciate that. Let's get into some of your top lessons for a wealthier retirement. And for those in our audience, if you want to get in on the conversation, you have a question for John, you want to pick his brain, make sure you submit those questions to us as well. If you're watching on Webworker, you can use the chat box to send your questions to us. If you're watching on our broadcast platform, you can use the questions and comments box. And if you're watching on our YouTube live stream, there's a link in the description that will take you over to our broadcast platform, and that's where you can ask your question to John there. Okay, John, I want to start things off with a quote from your book, Findependence Day, and it goes like this: "The foundation of financial independence is a paid-for home." So in your opinion, just take us through why is it generally a good idea for Canadians to avoid retiring with something like mortgage debt or another major debt?
Yeah, well, it's whether, do you want to rent? If you don't buy a house in Canada, then you're going to be renting. And, my experience with landlords from when we used to rent was the rent keeps on going up and up and up to the point where, right now, I think young people are finding, apartments in Toronto, $2,500, $3,000 for a 1-bedroom, 2-bedroom apartment, which is not even paid for by CPP or OAS together. I have family members in that situation, so I know. So Ideally, you go back in time 30 years and you bought a house when there were 200,000 instead of 2 million, and you paid for it in 3 or 4 years. I remember kind of being quite obsessed with paying down the mortgage. Once I realized how the banks, TD included, made so much money on interest, on mortgage interest. So when you realize the power of paying down the principal, and then, so I had this idea that once you had no more mortgage, it'd be like living rent free. Now, yes, there are other things. There's property taxes and there's maintenance expenses. We just had a big job on our house. So it's not like you're getting off scot-free. So to me, anybody who wants to retire ought to buy a house, pay it off, and then they can start to divert the previous mortgage payments to building up their wealth, RSPs and TFSAs and such like. In fact, I think I did a piece in Money Sense. My last Money Sense column was with Rob Carrick of the Globe and Mail, who just retired from the personal finance beat. Although he's still there, semi-retired, he's going down the same route as myself and Dale and all these other people in the retirement club.
Yeah, that's a good point you make about the ongoing cost of owning a home. I can tell you firsthand, of course, as I'm sure you can, there's always something that comes up to spend money on with a house, whether you own it outright or not. One of the trends, though, that I've seen being talked about more in the market with retirees is this idea of a reverse mortgage to help fund your retirement in part, if not in whole. What do you think about the idea of a reverse mortgage?
Well, I used to talk to P.J. Wade, who wrote the book, I think, Your Money or Your House. I can't remember. But basically, most people would say it's kind of a last resort. Now, it doesn't mean I'm totally against it. I have a friend who has no children, has no heirs. And in his particular situation, it made sense. I said I couldn't really give him the case for not. It's sort of a stream of tax-advantaged income. He didn't have huge assets. He found that it really helped him on the cash flow. It didn't really matter that it's essentially the die broke strategy, or die with zero, since there's no heirs. But for most people, if you do have heirs and you have other ways to bring in money, I would put it down like, number 7 or 8 on your list when you're looking at ways to bring in money. I mean, far better to have a pension, and RSP income, and RIF income, and investment income from a non-registered account. All these things are better or even having an annuity that you buy.
Well, take me into a little bit more depth on your thinking behind that. Like, is there some kind of hidden risk that people need to understand about a reverse mortgage that they want to consider before they get into one?
Well, it's still a mortgage. You're just losing equity. I mean, you built up the equity in the house, and in some ways it makes sense. Like, I understand the appeal of it. I looked into it at one point because you've got an asset in your house, and which normally is just kind of a sunk cost. And here's a way that you can bring in money and tax advantage at that. That's a good thing. But again, I've not actually done it myself. Most people, I don't think, the need to do it. As I said, there are exceptions, particularly people without children, perhaps health, and there are many reasons. Every person, as you know, is different circumstances. So it's always dangerous to make blanket generalizations, and I'd include reverse mortgages there. I'm not saying it's bad. I'm just saying it's not my number one priority.
Right. Okay. So I like that idea of maybe thinking about it as something of a last resort, or at least lower on the priority list here. I want to shift to asset allocation, which is obviously a big focus for a lot of retirees here. How do you think Canadians should generally approach asset allocation throughout retirement, generally speaking?
Well, it's a fundamental thing. I mean, there have been studies that asset allocation is more important than individual stock picking when it comes to your investment returns. I'm a big fan, and most of the people you've had on the show that I know of are big fans of ETFs, exchange traded funds, and in particular the new asset allocation ETFs. Not that new. I think Dale Roberts had something I reprinted on the Independence Hub just a week ago or two on how well these Canadian asset allocation ETFs have done. And it makes sense that people say investing is so complex and you need help. Yeah, you do need help on the emotion side and investing and tax and insurance and estate planning. All these things are good. But the actual nub of the investing process it can be quite simple. With a single ticket, you would call it in your business, one sale of the VBAL, Vanguard Balanced ETF, or the BMO one, or the iShares, to name three big ones. They're all much the same thing. They're 60% stocks, 40% bonds. They're spread around. They're geographically diversified. So you're not worried about just the U.S. over, the S&P 500 is too weighted to the big seven, magnificent seven. Not a problem, because they have an equal amount of EFI and emerging markets and Canadian, not to mention bonds and perhaps other asset classes like real estate and gold. So asset allocation ETFs are, to me, and they're low cost. They're like 22 basis points thereabouts. Plus, there's automatic rebalancing. So really, it can be very simple.
Yeah, they certainly take a lot of the thinking and the effort out of the portfolio management process. And when you're in your golden years, you want to be enjoying them, right? You don't want to be glued to your monitor the whole time managing your portfolio. We had a graphic up earlier talking about some of the rules of thumb around deciding what your fixed income portion should be. How do you kind of approach that in retirement? I know some retirees wonder, do I have to maintain a higher exposure to equities just to get the returns to get through my retirement and fund it? How do you think about the fixed income portion?
Well, the standard rule of thumb, which is a useful starting point, is that your fixed income should equal your age. So in my case, I'm 72. So that rule of thumb would be I should be 72% in fixed income and what's the rest? 28% in stocks. But like many rules of thumbs, that's probably not really the best. John DeGoey, who another advisor I think you know, and he wrote a blog on just for me earlier this week, has a more complicated variant of that rule of thumb. Maybe you have it on. You can show the readers, because it's something I cannot remember off the top of my head.
Yeah, we just had it up for everybody. Yeah,
and but even then, he goes. But don't go. He thinks a retiree should stop at 50%. That is, you should not have more than 50% fixed income, if I understand him correctly. But he's got this more precise rejigging, but still amounts to the same thing. But the main thing is have some bonds as ballast and some cash. Because, a severe bear market correction, who knows whether they can last a year, 2 or 3. They don't usually last that long. But if they do, and we'll probably talk about RIFs here, you got to fund, come up with, $5,000 a month or whatever your target is, and stocks are crumbling, then it really is nice to have fixed income. It can be ladder of GICs, guaranteed investment certificates. It can be bond ETFs. It can be mutual fund ETFs. It can be cash in the bank, bank savings account, all sorts of ways to skin that cat. But you still need the commitment to that. I'm not 100% stocks. In fact, I don't believe in 100% of any asset class, or in fact, 100% of anything in life when it comes down to it.
Right, diversification, the only free lunch in investing, as they've called it. So it sounds like you're a big believer in that. One thing I wanted to ask you about too is how a pension factors into things. Some people have a defined benefit pension plan. Some people have defined contribution. Some people have no pension at all. How do you think the type of pension you have factors into your asset allocation in your investment portfolio?
Well, it's huge. When you think about it, a pension, a defined benefit pension is a stream of fixed income, like an annuity. Sadly, a lot of people don't have them anymore. I mean, number one, you had a lot of job jumping, so you tend to have a little pension, and then you kind of commute it and collapse it and it goes into your RSP, which is fine as long as you treat your RSP as your own private personal pension fund. We all know that the two main types of pensions are the defined benefit, which are typically the government workers, people working in big, well-paid unions, politicians, etc. They'll have the guaranteed by taxpayers defined benefit pension. Those in the private sector don't really have those, not very often. They're kind of becoming rarer than hen's teeth, as they say. In which case they have defined contribution plans, which are similar, but there's no guarantee. And so you're back in the game of like managing an RSP or your own RIF. You got to worry about asset allocation to create the stream of income that if you're a member of a big defined benefit plan would be giving you automatically.
So if I'm reading you correctly here, maybe someone with a defined contribution plan might have to be a little bit more aggressive, or at least want to consider being a little bit more aggressive to kind of make up for that lack of guarantee. And then, or sorry, I should say the other way, they need to be more conservative. And somebody with a defined benefit plan, which is kind of like a fixed income in some senses, right? They could stand to be a little bit more aggressive with their asset allocation in their investment portfolio. Is that a fair summarizing?
Well, in a way, yeah. So if you have a really general, lucrative defined benefit plan, you're sort of laughing, aren't you? Especially if it's the government. I joke sometimes. You see in the Globe and Mail and the Post, they have all these profiles of family finances, and I think they're one of the most well-read features in newspapers. But half the time, it's like you kind of look at it and says, "Well, Joe and Sarah are both members of a federal civil service." I stopped reading. It's like there's nothing to read. It's like, okay, there's that. No, but so going back to the retirement club, these people are more typical. They've been in a number of private sector jobs, or they're self-employed, and the old thing, nobody cares about your money more than you do. And so if you have a bunch of pension plans you've collected from various employers over the years, and they're all basically been rolled into your RSP, at that point, well, to your point, are you going to take more risk? You certainly want to include fixed income, because you don't have the fixed income stream that in effect an annuity or a defined benefit pension plan is. But to your other point, but you also want to make the part that works hard, the 50% or 60% that is in stocks, you really wanted to make that do the heavy lifting for you. Not to some point, it's all about risk tolerance and what you're comfortable with. Some people are comfortable with 70% stocks, even at my ripe old age, but we're all different.
I want to talk to you a little bit about diversification a little bit further there, since you brought it up. And one of the things I've seen in the headlines that some are concerned about is this idea of the potential return of stagflation. You talked about how you like to diversify. I'm wondering if you're diversifying into any of these alternative assets, your gold, your commodity, real estate, maybe even crypto perhaps, as a way to sort of hedge against that risk. Is that something that's top of mind for you?
Well, all of the above. Again, going back to Dale Roberts, he's been big on crypto. I had a little crypto, maybe 1 or 2% total position, going back when it was before it really started to take off. I treat it as cautiously. If you get a double, I say like sell half of crypto and redeploy. I'm more over the years more positive about gold and precious metals, particularly right now. You see the TSX, Toronto Stock Exchange, is at all-time highs this week, based largely on the gold mining stocks. And don't forget silver mining stocks as well. I've always thought 5 to 10% in gold and / precious metals, whether bullion or miners or actual physical in your safety deposit box, is a prudent way to hedge against, economic Armageddon, essentially. Personally, right now, since I began a RIF, I'm always looking to sell positions which are up. Lately, that's been a lot of gold. You're sort of forced to, buy high, sell low. So when it's high, you want to sell what's winning. And I'm glad to have those positions. I can give you a few suggestions if your readers want to get granular.
Yeah, I mean, I think the takeaway here obviously is diversification from different asset classes can kind of help weather some of these storms that are out there. So appreciate you sharing that perspective, John. We got a lot more to come, but just a quick note to our viewers here. If you're enjoying the show so far, why not consider subscribing to TD Direct Investing's YouTube channel? We're also on Instagram. We're also on Facebook. You can check us out there. You can get a sneak peek at all kinds of upcoming episodes we have on our live shows and a ton of other content designed to help build your investing knowledge. So check us out. QR code's on the screen there. Okay, John, let's get back down to some of your retirement lessons here, and let's get into some ones around portfolio drawdown strategy. This is like the bane of your retiree's existence here. Do you have a way that you're approaching it in a fairly tax-efficient manner that you can share?
Well, you talk about RIFs, so or I guess you're drawing from everything. So, first of all, the TFSA, tax-free savings account, is a great deal. The problem with TFSAs is it's such valuable space. We never spend it, right? I tend to. That's the last thing you want to touch. because it's such a, most retirees, they look to, if I get to 90 and 95 and I've drawn down my RSP and my RIF and my non-registered portfolios are going down, they sort of look to this eventual savior in the TFSA, which, and lo and behold, is tax-free bonus. But in the meantime, most investors, let's say go back to 60s and 70s or even 50s, most of us have non-registered portfolios. We all know that Canadian dividends are taxed more efficiently than in U.S. dividends outside of an RSP. So clearly you should put U.S. big dividend payers like AT&T or Verizon or something inside your RSP. And you should put Canadian bank stocks, for example, or BCE in your non-registered portfolio where you can. Then when you get or the insurance companies, then you get a 4% dividend, and it's essentially 3% for you and 1% for Mr. Carney.
So it sounds like some optimization around where you're putting certain investments here. And my understanding too is that you're focusing more on drawing down your RIF and then kind of leaving other stuff off to the side a little bit later. Is that a fair thing to say?
Well, the RIF thing is new to me just this year. But all along, I mean, we all know at tax time when you get T3s and T5s and all those slips, that's generated by dividend-paying stocks or capital gains stocks in your non-registered portfolios. That never stops, not because you have a RIF, not in retirement. I mean, unless you actually liquidate your non-registered portfolios. I think most Canadians probably, I mean, their income stream is going to be CPP, OAS, an employer pension if they're fortunate enough to have one, and probably an RSP that has become a RIF, or in some cases they've annuitized, or both.
I know one thing that retirees often fret a lot about is this idea of sequence of returns risk. You know, particularly in those first few years, you have some poor market performance. It takes a big bite out of your portfolio, and then you have so much less to live on in the subsequent years here. Is there any sort of approach that you're taking or any tip that you have to help maybe mitigate that risk a little bit as much as one can?
Well, that's a tough one because it's the old, like, who can time the markets? Who can predict where interest rates are going to go, where stocks are going to go? I mean, clearly, if you look at the valuations right now, the U.S. market is richly priced, you know, CAPE ratio and all that. So it seems to me it makes sense to start to rebalance to perhaps more Canadian equities, if you believe that gold story we were talking about. I forgot, in that previous discussion, I should have mentioned REITs and real estate too, and commodities and other things. But not just Canada, EFI, Europe, Australia, Far East, and emerging markets. They're all been doing pretty well since this whole Trump trade of, what do they call it? The Independence Day. What did he call it? Liberation Day in April 2nd. The U.S. dollar has been losing ground to the Canadian dollar and other currencies. And in fact, people have been so blinded by recent returns in the U.S. market the last 5 years, they've sort of probably underweighted Europe and the Far East and maybe even Canada. But those who did not, but basically, again, back to the asset allocation ETFs, if you just maintain that non-U.S. equity exposure, you're quite happy so far in 2025. And with all these tariff exposure and anxiety, who knows? Interest rates is related. Again, it goes back to Trump. Clearly, he wants the Fed to take the rates down because the U.S. has quite a huge debt problem right now. What are they, like 37 trillion? I've forgotten the number. You can tell me. And so Trump clearly wants interest rates to go down, so the cost of running an almost out of control balance sheet there in the United States is going to be mitigated a little bit.
I know one of the things you've written about is this idea of holding a cash wedge in retirement, so that if something catastrophic or some kind of big downturn happens, you don't have to sell your investments at a loss. Can you just take me through the thinking behind cash wedge and how much cash wedge is enough in your view?
Actually, a cash wedge is Mark Seed's thing. I think you've had him on as well, of My Own Advisor. It's an excellent blog. So my understanding of cash wedge only comes from having edited and run some of his blogs. But my understanding is I'm not sure what the wedge is. I mean, cash is cash, right? So whether it's a money market fund or cash in a daily interest savings account or GIC, some combination, that is accessible and liquid. I mean, the problem with GICs, 5-year GICs, is they're not very liquid unless you ladder them so that every 6 months or every 3 months some comes due. So you tell me, but if a cash wedge is highly liquid cash that also pays a decent amount, that's the tricky part, because as we know, money in the bank doesn't pay much, if anything, and money market ETFs or mutual funds probably pay pretty minimal. I haven't looked at it lately. Personally, I rely on bond ETF income and GICs laddered, and then go again. I'm sounding like a broken record. There's going to be cash as part of the asset allocation ETFs as well.
Yeah, that's right. I know Mark is a fan of having 1 to 2 years of a cash wedge just kind of sitting by there so that you can use it as you need and not necessarily have to worry as much about your portfolio returning to value. Speaking of great bloggers, and you mentioned him earlier in the show, Michael Wiener, we spoke with him a few months ago about a much debated topic, and that's when to start CPP and OAS payments. Of course, the traditional wisdom once upon a time was that it can be better to take CPP early, but that attitude seems to be changing a little bit, and Michael, in his experience, actually delayed CPP and OAS until 70, or at least that's his intention here. And he walked us through his line of thinking. So let's hear what he had to say.
The math just says that we're better off with more guaranteed income indexed to inflation than we were to have more savings invested in risky assets. And in fact, when we do an analysis of how much we can safely spend, the decision to take CPP at 70 instead of 60 allows us to spend about $7,000 more per year starting right today. We're retired, and we still have quite a few years to go till we're 70. So it seems counterintuitive, but we can safely spend more now because of the decision to wait till we're 70 to collect CPP.
All right, John, so that was his logic behind things. I'm curious what you think about his thought process there, and how did you tackle this in your own retirement?
Yeah, it's almost a staple of personal finance journalism in Canada that you should wait till 70 for both CPP and OAS if you can pull it off. The problem is that some people need money before as early as 60. I would certainly encourage people not to take it as early as 60. In fact, given our lifespans and longevity expectations, I would encourage most people to keep working at least part-time or self-employed, and at least until age 65. So don't take CPP before 65. As to 70, yeah, nice work if you can get it. But at that point, sometimes you don't get a choice in the matter. You can lose a job or an employer, or if you're self-employed, you can lose clients, and in which case you may need the money. Personally, you asked me personally, I took it at 66 CPP and OAS at 65 when it became available. I was pushing for my wife, who's a year younger, to wait till 70 on exactly Michael's logic. In the end, though, ironically, we took it for her at 68 and a half because Fred Vertice, he's a Globe and Mail columnist and actuary, retired actuary, and he had done a bunch of articles explaining why, with the inflation adjustments, you get paid. It actually made sense to take CPP a year earlier than you might otherwise. So if you're thinking of 70, he would have said, take it for 69. This particular year, he wrote this story, which is a couple of years ago. So I like to think that between my wife and I, we averaged out at 67, which is good enough for me. It's not 70, but it's a lot better than starting at 60. And you can go through the same conversation with OAS too, but it's not as much as at stake because OAS is a smaller absolute amount than CPP for most people.
Mm-hmm. Yeah, Michael made that point as well too, of delaying CPP and OAS if you can swing it. If you need the money, you need the money, as you say. But if you can push that off and get a little bit more guaranteed income coming your way through these programs, all the better for it, right? Obviously, we talked about OAS a little bit there. OAS clawbacks, a big concern for some retirees. Granted, if you get a lot of your OAS clawed back, you probably have the good problem of having a lot of income coming in, but of course, nobody likes to have that income clawed back if they can avoid it. Is there anything that you're doing to help avoid being subject to OAS clawbacks?
funny. I got something from the CRA just last week, warning me that they're gonna start taking a little bit of it away. You know the numbers off the top of my head. What is it? Somewhere around 90,000 per individual, where beyond which the taxable income starts to have the OAS claw back. That's only starts to have a claw back. I believe it's not fully clawed back until you have maybe $130,000 of the taxable income in any given year. So clearly, if you know what those numbers are, maybe you're able to show them on the screen here, the exact numbers. Say it's 90, might be 89, it might be 91. If you know what the number is, then you should strive to keep your income below that. I mean, clearly a couple should be able to live on 90,000 each in retirement, and if they hit 95, then yeah, it's not really a catastrophe because you've got the extra dividend income, presumably is what's causing it. On the other hand, gee, you paid into it, you really feel like you should. The government owes you somewhat. So it's just a matter of you have your financial planner or use some of the software available and compute all your sources of income from pensions, all sources, et cetera, annuities and investment income and your RIF and RSPs, and strive to be below. It's hard to, in my case, it's probably going to go up above it, and there's nothing much I could do about it. I mean, you're already invested in, it's probably the non-registered portfolios that are doing it, and you have the things like, if companies keep on increasing their dividends, well, that's good. Can't complain about that. And then, of course, the Canadian tax system is the dividend gross up. So you actually get, the government says, if you got 50% in a dividend, it's actually grossed up for tax purposes, so it looks like you receive more than you actually did. I call it phantom income, but welcome to the Canadian tax system.
Yeah, and just a quick note there, the upper threshold where your OAS, is completely clawed back. It's just a tick under 150,000. So even higher there, Yeah, I had to check my notes there.
Clearly, it's a rarefied atmosphere I'm not in yet, so I don't know about that.
In any case, yeah, one last thing I wanted to touch on here, John, with you is RIFs. Some retirees often wonder, when do I convert to a RIF? When do I hold off? Should I hold off longer? How did you navigate that process? Yeah,
I mean, for the most part, it makes sense just to wait till your 70s. The end of the year, you turn 70, or 71, I guess it is. But you can also start them earlier. But for most part, you don't need to do that. I chose not to, and I must admit, the late Adrian Mastraki at KCM Wealth Management used to be a source of mine when I worked at the Post, and he made the point that it's a lot more flexible. The RSP is a lot more flexible in your 60s than the RIF is, and you can if you're basically, most people want to do an RSP meltdown because they want to take more tax in while they're in a lower tax bracket, because once you hit let's say you start getting a really good defined benefit pension plan at 65 or 70, and your RIF starts to kick in at 71, at that point you're not going to have much flexibility. The income you're going to get is what you're going to be getting, whereas in your 60s you can slowly draw that, take more money out of your RSP than you need to if you're still in a lower tax bracket. It's a way of harvesting income that's not taxed as badly. Am I making any sense?
Yeah, absolutely. The RRSP meltdown, as you mentioned, a very popular strategy, certainly. And yeah, that idea of taking income from your RRSP that you're forced to be taxed on, essentially, before other sources of income kick in, can be a good way to kind of help do things. And then your RIF, when you do convert it, doesn't have to be so large, and you don't have to have such large mandatory withdrawals from it. So a really good point there, John. Appreciate you taking us through all these retirement lessons that you've learned over the years here and through your own experience. We got tons of questions coming in from our audience here, so we're going to get to that in just a moment. But before we do, I want to bring in my colleague, Caitlin Cormier, because there are so many tools on WebBroker that can help retirees track how much income their portfolio is generating for them in retirement, and just help them stay on top of managing their portfolio through the process. So Caitlin, I want to bring you in so you can show us how to do all this stuff. Welcome to the show.
Thanks so much, Rob. It's always a pleasure to be here.
Absolutely. So take us through something about how WebBroker's tools can help manage the income flow that a retiree may have in your portfolio.
Absolutely. Income is such a huge piece, right? When you talk about the different types, as you guys are chatting about all these different types of investments, you've got dividends, you've got interest coming in from the fixed income portion or kind of bond portion of your portfolio. How do you keep track of all that, right? All this money that's coming in, you can go through and calculate it out yourself. But, who really wants to waste any time doing something like that, especially when you're busy working or when you're busy enjoying your retirement. So let's hop into Webroker and we'll look at our projected income tool. So under the accounts tab here on the left hand side, we are going to come down to the second last option here on our list, which says projected income. When we click there, we are going to just scroll down a little bit, and what we'll see is a projected income on a per account basis. So you'll notice here at the top, I can select whichever, a particular account, all non-registered, all registered, however I'd like to see it. And then I'm seeing a visual representation here of what my monthly distributions are going to be. This is a projection for the next 12 months. So of course, this is assuming, dividends and distributions don't change for any of the securities that you hold, that you don't buy or sell any securities, right? It's not a completely perfect system, but just kind of making some of those assumptions. This is what your distributions will look like over the next 12 months. If you scroll down a little bit, you can even see each individual security, how much the total will be for the year, as well as what's going to be coming out on those securities on a monthly basis. So again, something that you can do yourself if you wanted to, but sort of an easy way just to have it kind of done for you automatically. There also is an opportunity here to click and choose a monthly target. So if there is a specific amount that you're looking to have in income per month, you can put that in there as well and see how far away from it you may be throughout the year.
I'm not anywhere close to retirement, Caitlin, but I love looking at this tool in my own portfolio just because I love seeing like the bars up there and hey, like I got income coming in and stuff like that. Not drawing from it just yet, but it's a nice thing to see. So that's great. Thank you for showing us that. The other side of the coin here, as John and I were talking about earlier, is asset allocation. It's very top of mind for retirees here. They want to make sure they're not taking on too much or too little risk inadvertently here. What tools are there in Webroker to help them stay on top of that?
Absolutely. Just to say the projected income thing, it also makes me feel like I'm doing something when even if I'm not taking the money out, it's really nice to see it building there, right?
Totally. I feel
I'm making the right decisions. The money's still coming in. Absolutely. So asset allocation is a key part of any investor's portfolio, but when it comes to retirement, extremely important to make sure that you're sort of in line with what your risk profile is and making sure you're not having kind of too little or too much risk. So let's have a peek at that.
You may have noticed when we were on this screen before that you can actually see a visual representation of asset allocation at the top of this screen. You can see here where your portfolio is broken down between Canadian equities, US equities, fixed income, cash. But if you're looking for a bit of a deeper dive, you can simply come to this tab, the allocation tab. And once you're here, it will actually break down further and not only show you which categories your money's invested in, but it'll show you which securities are within those specific categories. So for example, within the Canadian equities, you can see that I have 3 different securities as well as a mutual fund. You may have noticed at the top, it does show that in this portfolio, there are multi-asset class funds. All that means is when we see this fund here at the bottom, it has a portion that is Canadian equity. It also has a portion that's US equity. And there is a portion of it as well that is Canadian fixed income. So any types of funds that you have, those all-in-one type of ETFs or mutual funds, they will show up appropriately within your portfolio, represented in whichever category they're made up of. So just kind of a further way to use this tool to see where you're invested, especially when you're rebalancing. It makes it a little easier to know which securities you may want to sort of buy and sell in order to get your portfolio back in line with your objectives.
Yeah, it's a nice little breakdown there in the different categories, and sometimes they overlap in categories too, so you can just get a really fine-tuned look at what kind of exposure you actually have in your portfolio. Appreciate you showing us that, Caitlin. Much appreciated here. We'll see you next week for next week's show, but appreciate you walking us through the ropes there. That was Caitlin Cormier, our Senior Client Education Instructor at TD Direct Investing. Okay, John, you're obviously a very popular guy here because we got questions flying in from our viewers here that want to pick your brain about all kinds of things. You ready to hear what they want to know more about?
I guess so.
All right, Paul's first up here on the docket. He says, what's John's view on annuities, especially prescribed annuities? Are they worth considering given concern about future inflation? What do you think, John?
Yeah, actually, this was a topic that was on the Retirement Club just a couple of weeks ago. And I think a lot of my view is that, again, going back to Fred Batiste, he says when you're annuitizing, let's say you have $1 million RSP, for example, he argues, but again, going back to our discussion about defined benefit plans, if you don't have a defined benefit plan, I think it's a good idea to have some annuities. So maybe you want to partially annuitize. So that $1 million could be 300. Fred says 20 or 30%, I believe. 20. So you might have 200,000 or 300,000 in an annuity and 700,000 or 800 in your RIF. So that's now prescribed annuities is the opposite. I mean, when we talk about annuities or RSPs, we're obviously talking registered investments. Prescribed annuities, as far as I know, and I haven't done them myself, so I may not be the best person. That's where you take some non-registered capital gains or properties, and you generate basically tax-advantaged income. Like the annuity, you would get a stream of income, but it's going to be comparable to how dividend income is taxed. Better tax rates than you would get on a straight life annuity or fixed income payouts. So some advisors I know really like the idea of prescribed annuities because of the tax side. Others think it's just easier just to stick to the registered side. So again, different strokes for different folks.
Mm-hmm. Yeah, personal finance, always personal, of course, and that goes for retirement as well here. But some tax advantages to consider with annuities. Appreciate you walking us through that. I believe Todd is next up with a question here. Let's see what Todd wants to know. He's saying RRSPs can feel like a tax trap, deferring tax now only to pay full tax later on both earnings and principal. Plus, you lose preferred tax benefits like capital gains treatment and tax loss harvesting. What's your take on this?
Well, for the longest time, at least certainly for the baby boom generation, those of us who are now retired, RSP was the only game in town. Yes, TFSAs are a lot better if you can. I mean, it would be really nice if I could, get the genie out of the bottle and change every dollar that's in RSPs registered into a TFSA, but it doesn't work that way. You'd have to pay a big tax just to make that happen. So the way it is, I still think RSPs are a pretty good thing to do, particularly if you're a young person and you're starting out, and if you're employed and your employer's taking tax off at source, why not just automate the whole thing? And now, I say that, but if you're not making very much money when you first start, as in your career, it could be that you're not in the top tax bracket, in which case you might want to take the money that they would suggest going into an RSP and put it into TFSA first. But that can be maxed out. You only get 7,000 room, whereas with an RSP, you get, 27, 30, almost $1,000 room if you make enough money. Personally, I think you should do both. Maximize your RSP, maximize your TFSA, and maximize non-registered investments. When you filled up those two shelters or semi-shelters, just save, invest. So I think the RSPs has a compelling tax reason to do it. Yes, you pay a tax down the road, as I found out with RIFs, but it's not onerous. The very fact you've got a nest egg that was partially funded by the government and a lot of deferred capital gains and income makes it more than worthwhile, because it's not just the tax refund you get every year when you make your contribution. Remember that you also have 30 or 40 years perhaps of dividends and interest that have been accumulating and compounding inside and growing, and you only pay the piper at the end when you get the RIF. And besides, maybe you'll die and then you won't have to pay.
Well, let's hope it doesn't come necessarily to that, but I suppose the morbid logic behind it, is true. But yeah, you're right. I mean, that's a long time for investments to grow tax deferred potentially here, so there's certainly benefits there. Let's get to our next question, I believe from Rosano. What kind of bond ETFs would you recommend to make up the fixed income portion of a portfolio in the current environment? Passive or active strategies? What do you think, John?
Well, I don't know that much about the active bond fund. I'm not sure if I look at my portfolio, I could find many. I mean, again, you go back to, I guess you could think of an asset allocation ETF, which we discussed ad nauseum here. The bond portion of those would be doing the job for you. But if you want pure bond ETFs, sure, Vanguard has good ones. What's it? I can't remember the symbols, VVSG or something like that. BMO has them. They all have them. iShares and other companies I may have forgotten right now. You get the problem with interest rates right now. So you figure, okay, so Trump's going to get the Fed to knock rates down next month or so. Bank of Canada is probably going to follow. So it's the old thing of probably you want to go short. You might not want to be buying long-term bonds right now, but Rob, you may correct me. I'm not great at bonds and bond incomes. I'm more of a stock guy.
Yeah, I feel like bonds are definitely like a harder one for a lot of investors to wrap around. There are tons of providers out there with tons of options, passive and active. I think that the takeaway here is that, as you were saying earlier, some exposure to fixed income like that is probably worthwhile, particularly for a retiree, just to kind of tamp down on some of that volatility. But yeah, there is a little bit of an interest rate guessing game going on right now in the market, certainly. But anyway, we got a lot more questions to get to. Let's move on to our next one. This one coming to us from Deborah. Deborah wants to know, if you have to choose between receiving a lifetime defined benefit pension or taking the commuted, lump sum value of it, what factors should you consider when making that decision? This is a good one.
Well, personally, I think defined benefit plans are great, and if you're lucky enough to be in one, you should take it. I mean, the whole point is you're going to end up managing some of your own money anyway in TFSAs and other vehicles and non-registered investments. So if you've got a professional organization who's investing a big chunk of what's going to be your guaranteed, it could be 30% or 40% of your ultimate income in retirement, take it. The moment you commute it and it goes in your hands, you're moving it from the hands of a professional into the hands of an amateur. You and I, we're all amateurs by comparison, and we can make mistakes. So there's plenty of areas where you can make mistakes anyway. So let the pros do it if you're lucky enough to have such a plan, and make your mistakes with the stuff where you have no choice but to do it. So I don't believe that most people should commute their defined benefit plans.
Just one less thing to think about in retirement, right? You got all things going on. It sounds like you're a fan of just taking your hands off the wheel to some extent and let others sort of manage at least some of it. So food for thought there, Deborah. Let's get to our next question coming into us here. Irene has a question. Hi, my house is fully paid off and I have $400,000 in my investment account. Is that enough to retire now at age 45? Whew, that's a big existential question here, Irene. I don't know that we could answer that kind of question with such limited information, but I don't know, John, maybe give some general perspective on this one. Retiring at age 45 with $400K in the bank.
I'd rather keep working to 60 and make it 800,000. I mean, to me, 45 is way too early to retire. I mean, how do you define retire? Do you mean, people talk about, is it like you no longer want to be a salaried employee working 9 to 5 with a boss and meetings and all that stuff, salary reviews, or do you mean retire as in self-employed, you're a consultant and you're your own person? I can't see retiring at 45 from both salary employment and even self-employment. But yeah, so my bias is like, I'm 72 and I'm still kind of working. And it's not so bad. It's kind of fun. It passes time and it pays better. So, and 400,000 is not all that much money, really. I mean, you got 40 years to go, maybe even 50 if you're lucky. Inflation can really knock 400 grand into 200 before you know it in about 15 years. And what I can't think of a better thing to have done than those extra 20 years after you're 45 than to build that nest egg up. You can only travel so much, as I know from coming back from France.
Yeah, that's true. I mean, again, it goes back to what we were talking about earlier, retiring to something rather than just from something. It might be better to, at least if you are going to retire early, have some sort of income that you can enjoy. Maybe it's a passion project that can help sort of buttress the value of your portfolio just in case things go awry somewhere during your retirement period, which if history is any guide, probably going to happen if you got like a 30-plus year retirement here, right? Okay, let's get to our next question here. We got another one coming into us from Cleo, and they want to know, in what order should I withdraw from my RRSP, CPP, and TFSA to optimize my retirement income? Now, of course, your CPP is coming in regardless, but RSP versus TFSA withdrawals, John, what do you think?
Well, I've never taken money out of TFSA. My daughter has on occasion because she has a cash crunch. But for the most part, as I said earlier, to me, TFSA is I'm not taking that money out. It's just too precious an asset until 90 or when you really, really need it. I mean, I guess we talked about reverse mortgages and the dire last straits. Well, to me, the second most dire would be having to tap your TFSA early. So we talked about the RSP meltdown earlier, and so you want to take the money out of your RSP ahead of a TFSA, preferably in your 60s when you're in a lower tax bracket. If you know you're going to get bumped up because the big pension comes in, the defined benefit, and your RIF eventually, what's left of your RSP, because your RSP's less if you have a big pension, that's the deal.
Yeah, what you're describing there is a way to kind of even out the tax that you're going to take across retirement rather than making things really lumpy over the course. So great food for thought as well. We got time for one more question here. Let's take this one from Adil. For the cash wedge covering the first 3 years of expenses, you invest in GICs, cash, and high interest savings accounts. What investment instruments do you recommend for the cash wedge covering 3 to 6 years of expenses? Okay, so like a much more long-term cash wedge that Adil is looking for here. Do you think that there's anything in the mix that might be a fit here for him, John?
Well, personally, I would have like 3 months just in the vehicles that don't even pay anything. I mean, most of the banks that I deal with, in the investment account, like I always have a little cash for the RIF ready to roll out. And I don't think that pays anything, but I just don't want to think about it. And then the second level would be some of those short-term bond ETFs we discussed from Vanguard or iShares or whoever. They may go down a little bit, even those, because of interest rate fluctuations, but it won't be a killing thing. But for the real heavy lifting would be the from 1 year to 5 years or 7 years would be laddering those GICs. So, one, 2, 3, 4, and 5 year GICs, preferably maturing 3 or 4 times a year, maybe each season. They tend to pay pretty well, even in this environment. And but again, the problem is lack of liquidity. But that's made up, in fact, in part by the cash wedge of those other vehicles we discussed. And worst case, remember, you can always sell stocks. If we're in this ultra bull market, which we seem to be in right now, don't forget you can take profits in gold and stocks and AI stocks and whatever else you may have gotten that's got done well. Better actually to be forced to take profits on speculative stocks that surprised you on the upside, because you may get surprised on the downside soon enough.
Right, yeah, and it does come back to that diversification aspect too, pulling from different sources here as you can, just so that you're covered all the way there. GIC ladder, great suggestion. I know a lot of retirees also like to use those as well. So appreciate your perspective, John, on all things retirement here and taking so many viewer questions. There was so many more to get to, 1,000,001, but we really only have time for so many here. We'll have to have you on again real soon, but really appreciate you taking the time to join us this week.
Well, it was fun. Next time we'll do it in person, hopefully.
Yeah, awesome. Sounds great. And to our audience, of course, we appreciate you tuning in as always. Make sure you check out next week's episode. We've got a really interesting one coming up here for you. John was just talking about, maybe getting out of things when things are good. We've got another blogger, Craig Stevens. He's going to be sharing with us his strategy for preparing your portfolio for the next market downturn before it happens while times are still good. He's got a lot of tangible tips to share, so make sure you tune in for that. It's going to be a great one. For now, though, that's all the time we have for this episode of Inside Investing. From everyone on the team, we appreciate you tuning in. We'll see you all next time.
Have more questions? Check out the links to the right and in the description below.